Hello and welcome to On the Couch with Steve, a podcast where we help you navigate the often complex world of buying and selling real estate, predominantly here in Ipswich, but in the wider Brisbane area, all the way up to Toowoomba. I'm Steve Athanates. I'm the owner of NG Real Estate. I'm joined today by Steve Beach from Stanford Financial. How are you, mate?
Very good.
Guess what we're talking about today?
Let me guess. Interest rates.
Interest rates. Okay, the Reserve Bank has met and has made a decision. So without any further ado, Steve, what did the Reserve Bank do and say?
So I guess we're right again. So we both
Yay!
predicted pause on hold. I guess I would love to be wrong and say that they've actually cut rates, but
Me too.
The cash rate does remain at 4.35% here in Australia. But yeah.
Okay, so big question out there now. So everyone knows we're on hold, we're on pause again. Okay, so what? And I think I read something like it's been years since we've had our last change, and that was up 0.25%. But it's been a couple of years. Nothing's happened for a couple of years.
Well, I guess November last year was the last rate rise. So
Yeah,
we've
so
been
it's
on
been a year, that's right,
pause
yeah.
for 12 months. It's been a long time since we've had a rate cut. So I guess the next stage now is looking at the inflationary data that's come out. There was a lot of, I guess, mixed comments leading up to the RBA announcement, particularly from a lot of economists and banks in regards to that the September quarter inflationary figures were 5.2 where we were September last year. Why they lifted rates, because we want to be in that target band of 2 to 3%.
Yes.
And they came out with inflation at 2.8%, which is exactly in the band, and everyone's like, yes, let's have a rate cut. But as we were talking just before, what the RBA is actually looking at is what they call as trimmed or underlying inflation, which means they take out a lot of the government subsidies that's been in place. So fuel excises and electricity excises. So once you sort of remove some of the government, I guess, intervention in regards to reducing the cost of living, it actually puts our inflation still at 3.5%, which is actually in line or in target with a lot of their predictions at the moment.
Okay. All right. So obviously, whilst disappointing for anyone who was, I guess, looking for relief, the reality is that the good news is inflation is tracking in the right direction. It has a downward trajectory, which is hard to say, and also I guess it's in line with the government's expectation or the Reserve Bank's expectation of where it should be. So obviously, that's interesting in itself. Obviously, we want it to go lower. Reserve Bank does meet again once more this year.
Yeah, in December. Yep.
December, and then they don't meet in January, and they won't meet again until February next year.
Yep.
So we'll talk about that, because obviously this podcast requires us to make a prediction about what's going to happen with the next lot of interest rates. So we'll definitely do that. Before we do that, mate, obviously sentiment across the board from, you're obviously in the finance industry. What are you finding with home loans? Is it increasing, decreasing, stagnant?
We're still, I guess, extremely busy. Whereas, I guess, there's a lot of, advertising and media hype about, rates are starting to get back below 6%. So we're not really seeing much in the way of variable rates below sort of 6%, but we are seeing a lot of fixed rates dropping quite drastically, which kind of in lines with the fact that we are anticipating interest rate cuts, because the banks aren't going to offer you a cheaper rate than what they can borrow it at the moment.
Yes.
If they're not anticipating that rate's going to be continually going down.
So what's the best fixed rate someone out there could get?
I think roughly the cheapest fixed rate's about 5.49%. So for an owner-occupied property, so and that would be fixing over 2 years.
Now, obviously, people might see that as an opportunity to save some money, but generally speaking, if you locked in for 2 years today, you could actually hurt yourself in the long term.
This is a conversation that we have with a lot of our clients. We also talk a lot about what we call as a blended rate, where you might fix half your loan, you might have variable for half your loan, so you can kind of take the best of both worlds. Have the cheaper interest rate for the next 2 years or 1 year, for argument's sake. So what you're essentially, and I always call it gambling whenever you fix or go variable. So if you're fixing, say, at 5.5% and the variable rate's at 6%, so there's a 0.5% gap. what you're anticipating is that by fixing means you to be worse off on a variable rate means the rate actually has to drop all the way down to 5%. Because you're saving the 0.5% in the first instant, and then you'll be paying above in the next half of the year, sort of thing. So as long as I guess you're anticipating that the rates aren't going to drop that drastically, then fixing actually can become quite a lot more affordable. Actually increases your borrowing capacity as well, because the banks put on a 3% servicing rate. So if you're borrowing at 6%, realistically you need to be able to afford it at 9%. But if you're now borrowing at 5.5%, you're actually only borrowing at 8.5%. So you can actually borrow more money on fixed rates than you can on variable rates.
All right, so if anyone wanted to know more about their personal circumstances, they could obviously speak to you at Stanford Financial.
Definitely.
Beautiful. All right, mate, the time has come. We've obviously talked about what's happened. What do we think is going to happen into the future? So for the next Reserve Board meeting in December 2024.
I guess a lot of the banks and all economists, it's funny, like CBA have been saying December rate cut for months now. They're the ones that have actually now pushed out till February next year, along with probably about 85% of the general sort of consensus is a February rate cut, where everyone's saying still rates on pause for December.
So your tip?
My tip is definitely pause in December.
Look, my tip is on pause as well. I just don't think, even with this underlying inflation, I don't think the Reserve Bank will feel that they've collected enough data to see if it is a real reduction or, if it is just this stimulus that's really bringing it down. But I think rates will remain on pause or on hold for December. I obviously am very hopeful that we will get a rate reduction in February and not May, because the Reserve Bank doesn't meet in April.
Yeah, they don't meet in April. There is another meeting in March, but they probably won't have enough data in March to be able to, I guess, pull the trigger on a rate cut or a rate rise. That was a lot of the consensus through question time after the RBA announcement of rates on pause. Was there any commentary about, a rate rise or a rate cut? They're saying they're not. Usual story, they're flip-flopping, saying they're not going to say it's going to going up or going down. But pretty much everybody's just talking about, well, when's the rate cut? Not anything else now. So, which is good.
Well, that's good to change your language. We're not really discussing increases at all. It's always about a cut. All right, well, that's fantastic news. Mate, from a real estate point of view, the market continues to be amazingly strong. For October, we listed 70 properties in 31 days.
Wow.
We sold 64. That equates to just under $51 million worth of real estate that we transacted here at NGU. So the market is definitely still absolutely humming along. What we're saying to everyone is, generally speaking, everyone can only really ever see house prices increasing at this time. And I talked about borrowing capacity and all that sort of stuff. So at this stage, the message remains consistent. Even though the rates are on hold, we would still, as a real estate company, we're still recommending that you buy now. All the indicators suggest that house prices will continue to rise, even if we do get a price.
Well, it was actually a question that actually got raised in question time about real estate prices and stuff like that. She didn't want to speculate about what house prices are doing, but exactly what you're talking about is supply and demand. The demand out there outweighs supply. So
100%.
And that's not only from a purchasing perspective, but they're also talking about a rental perspective. There is still too much demand for rental properties versus supply. We are seeing an easing in regards to the increasing in rental inflation. So rent isn't increasing at such a substantial rate as it has been. But there's no clear sky in regards to, I guess, in like your world, is how far property prices are going to go up.
Well, the truth of it is, none of us 100% know for sure, but all the indicators suggest they will continue to rise because we have an undersupply. We have amazingly high demand, and that's the law of supply and demand. If there isn't enough stock, price goes up. If there's too much stock, price goes down. Right, so it's not brain surgery. All right, mate, once again, thank you so much to Steve Beach from Stanford Financial for coming in and helping us today. Invaluable, all the information that you provide, so thank you so much. Now, guys, for everyone who's watching out there, obviously what Steve's been able to impart has obviously, I hope, been very, very helpful to you. If you've got any questions, you'd like to make any comments, please subscribe to the link below. We'd love to hear from you. Your feedback is super important to us. So once again, I'm Steve Athanates. I'm from NG Real Estate here in Ipswich. If you look forward to seeing any more episodes of On the Couch with Steve, tune in for future episodes. We'll see you soon.